Well, welcome to our weekly High Rock video. I am Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. And we're going to chat about what we see happening in the global economy and financial markets and the world of wealth management and how we are adjusting our investing strategy accordingly. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. Well, as you know, we have three models that we utilize to create our portfolio strategies. And Paul, what do you have to tell us this week about what's been going on?
We did do some interesting trades over the past week. The first one is Cobalt 27, which is now our largest equity position on a single name basis. We sold some stock up at 13.57. We didn't quite get the high, as you can see by the chart, but that was on February 27th. So we got pretty close, but not quite. And unbeknownst to us, we thought we'd take a bit of profits. Our last purchase points were for some folks at 10.50, other folks at 12.50. We thought we'd take a little bit of profit, and lucky for us, better lucky than smart, the company came out and said they were doing a private placement issue of stock for accredited investors, which as a portfolio management company we are, at $11.40. And in fact, even below where it traded on March 2nd. So we ended up getting a full fill and buying stock at $11.40. And as you can see today, it's trading up around $12.30, $12.40. So we made almost a full dollar on our purchase. Now this new stock is a private placement, and we do have to hold it, but we do own other stock that we can sell. So it's almost an arbitrage. So pretty good trade for us at this stage. We're pretty close to this company and this management team, and I think this is going to be a decent position for us moving forward. So that was certainly one big thing that we've been working on over the past almost a week. We also did a interesting trade for those that have followed, but almost a year and a half ago, November 2016, we owned three, in our fixed income model, we owned three fixed rate prefs. We sold all three and bought three rate reset prefs, which have done really, really well. They've added value to our portfolios. One of those got extremely expensive on kind of a complicated implied credit spread basis. So we sold out of that entire position for all clients last week, and we're in the process of replacing that pref with a fixed rate pref, the same issuer, so no difference in the credit. So we're working on that right now. And, really some of that was a pure valuation decision, and also profit taking as well. So one pref looks really cheap to me and the other one's expensive. So we sold the expensive one and we're trying to buy the cheap one. Those were kind of the biggest changes to the portfolio, Scott.
So let me ask, just to help our clients to understand the whole rationale behind a fixed rate preferred share versus a rate reset preferred share.
Well, rate resets were actually, they're about 65% of the entire preferred share market in Canada. And the way a rate reset works, without going into a ton of detail on it, is most of them reset at a fixed dividend yield on top of 5-year Canadas. And as you recall, back in the summer and early fall of 2016, 5-year government of Canada and all interest rates, all government bond yields, really got hit down to really low levels. In fact, I think 5-year Canada's got down to around 0.75%, under 1%. So when you add on your fixed dividend yield, let's just say it's 2.5%, on top of 75 base or 0.75, all of a sudden the street woke up and went, oh my gosh, I'm going from having a 6% yield. My reset is coming in 6 months' time, and it's only going to be 4% or 3.5%. So these rate reset preferred shares got hit down really, really hard in price, and that hurt the overall preferred share market in Canada because they're such a big part of the market. Whereas the fixed preferreds are a fixed dividend for life, and the life is in perpetuity on these preferred shares. So now as rates are starting to rise, the rate resets continue to do really well, but you know what? It's the valuation got way ahead of itself. So I've got a pretty complicated Excel model on this, and we track it closely. So that's our really our switch trade, and it wasn't an urgent thing. It wasn't a massive call on interest rates or anything else. It was just the credit spread got ahead of itself, and the fixed rate looked a little cheaper at this stage.
But these are the opportunities that we're often and always looking for, especially from a tactical perspective. And the idea behind that is that it helps us add value to a portfolio, but at the same time, we're not taking any significant extra risk to get some of that return, right?
No, absolutely not. And as I said, the switch trade that we're doing is the same insurance company. Yeah. We're just selling their rate reset and buying their fixed rate.
Right. But
so we're really not taking any more credit risk at all.
Exactly. And that's really the key here, because one of the things that we do work very hard at is to try to reduce the overall risk in any portfolio, but at the same time enhance the return. So here we are finding ways that are not necessarily correlated to stock markets, maybe a little bit to bond markets because of the preferred share pricing, especially in the rate resets. But like we tell our clients and our prospective clients a lot, is that we're working very diligently to try and keep risk down, so we're not taking some of that stock market risk that's out there, and with really high levels of volatility over the last month, right?
Yeah, that's a great point. Actually, I was just myself talking to a retired woman prospective client yesterday, and I said our whole goal is to take the least amount of risk we can in your portfolio to meet your returns in the future. That's it.
Yeah. And
you're right. That's a good point. This is one way we're trying to do it. And there you go. It's been a pretty tough month of February.
February is a really tough month for equity markets specifically, and it's been very volatile. And you can see we haven't really. I mean, we're still seeing some pretty wide swings in volatility. Volatility's come down a little bit from what we saw sort of at the higher levels in early February, but you can look and see what was going on through most of or half of 2017, and volatility was very low, and there wasn't a lot of movement, but obviously volatility has been fairly significant, and it continues to be relatively significant with the moves. And
like the Dow. What was the Dow yesterday? I mean, I think it had over a 500-point swing from lows to highs.
Sure, and we follow the S&P 500 closely, and we look and we can see there's this kind of technical pattern developing, which tells us that when the market itself does break up or down through these two trend lines, either one, there's the potential for even more volatility, especially if it were to break down, because I think if it did break down, some of those folks that have been buying on recent dips may start to get a little concerned about what the next level would be.
Yeah, that's a good chart there. We'll have to track that as it comes into that right-hand corner of that triangle.
Well, interestingly enough, the big data this week in the United States is going to be the employment data on Friday, and it could just narrow in enough to make that data somewhat of a catalyst to drive the market one way or the other. So before we do that, let's just look at the long-term trend, though. We brought this chart up last week, and it's just, you can see since 2009 how the trend has continued to move from the lower left to the upper right, and for the most part, we're still in a bull market until it breaks that lower trend line. So markets are still positive. We think obviously that especially in the equity markets, and we've shown this before too, but we'll show it again. We think stocks are way ahead of the economy, and the economy has shown some signs to lately to maybe be doing a little catch up. We talked a little bit about positive signals last week, Paul. Something that we've noticed this week is that once again we're getting into a time where what we call the soft data, so things like consumer confidence and some of the manufacturing survey data coming out are quite positive, but some of the harder data has actually not been so positive. Today we saw factory orders declining by 1.4%, and last week we saw durable goods orders declining, and we haven't seen, the consumers taking a bit of a break in January after a pretty robust final quarter of 2017 for the U.S. economy. We will continue to watch to see what the consumer is doing, but we'll talk about that a little bit more. But when we talk about consumer debt levels, but as we've been pointing out, stocks got really cheap back in the beginning of February. Towards the end of February, they started actually to get a little bit more expensive, and they're kind of sitting in that slightly cheaper area right now. And that's probably why we've seen a little bit of buying of the dip. But I think we're going to be quite patient here and just watch and see how things develop. Here's another slide that we've shown before, but just to bring it back into context, this is a little dated. Paul, where are 2-year U.S. bond yields right now?
Oh, just slightly above it, 2.25.
Okay, so
2.25.
So at the point, though, having a safer yield on a government bond with a yield of 2.25 now is looking a lot better than a more risk-oriented yield of having a stock dividend, right?
Well, absolutely, and I think this really plays into talking about really massive pension funds. So pension funds have to do what's called asset liability management. So they have a pile of assets, the pension fund, and they have liabilities on the other side, which are typically very long dated, but they have to manage through the whole spectrum of retirees. And they largely need fixed income, and that being government bonds, to provide the more secure form of yield as opposed to dividend yield, which is really just a promise by that company to pay, which compare that to even a corporate bond yield, but never mind a government bond yield. But a government bond yield is, geez, what happens if the U.S. Treasury defaults on its Treasury bonds? We're all in trouble. So it's a very secure form of yield. So you start getting up around 2.25 and a 2-year yield, and you think, I wonder how many pension funds are going to do a asset allocation switch where they sell out some dividend-paying equities and buy a 2.25, 2-year yield, and then same thing in the 5-year, and you can move all the way up the curve. But it's really pronounced because I think, Scott, you probably have charts that show the flattening of the yield curve. It's really the front end of the yield curve of the 2-year that is starting to look somewhat attractive, I think, for large pension funds.
Well, sorry, at the same time, you can reduce your risk significantly by moving out of the equity market, which is, as we've looked at from a valuation perspective, relatively expensive, to the 2-year market, which has gotten a lot cheaper recently.
Yeah, it's starting to make sense.
And that's another reason why you may, as you said, start to see selling in the equity market is you'll see movement away from risk and into more safe situations. There's the yield curve in the U.S. There's the yield curve in Canada. As we have said before on our calls, when the yield curve gets closer to zero, historically that's indicated we're on the brink of a recession. Usually it's driven, as Paul was saying, it's driven by rising short-term yields, and usually that comes from either or the central bank driving interest rates higher. We know that the Federal Reserve now is expected maybe 3 or 4 interest rate increases over the course of 2018. The first one coming in a few weeks, and then in Canada, probably not so much. We've seen some economic data coming out of Canada recently that suggests that Canada pretty much spent its economic good times last year, and it may be a bit more of a struggle. And we can talk a little bit about that. Let's talk about the Canadian dollar and what's been going on with the Canadian dollar, Paul.
Yeah, it's certainly been hit down. I think it received another sort of shot last week when Trump announced these tariffs on steel and aluminum. Seemed to propel it even further down in Canadian dollar terms. But as you said, Scott, I think there are other underlying problems with the Canadian economy right now. And again, that goes back to part of our switch trade in the preferred share market. But I am not overly positive on the Canadian economy. Therefore, I think our interest rates will likely not rise as quickly at a minimum, and if not, at some point they could even fall. And I think that would shock the market and the most amount of people. So, yeah, I think this Canadian dollar I think it's going to gravitate up towards 131 area, which arguably would probably put it around 76 cents. And we'll see where it goes from there. But I don't think it's going stronger.
And we do have positions in U.S. dollar denominated assets for our clients in their accounts, which certainly portfolios have been benefiting from over the last few days.
Yeah, that's helped cushion the blow for sure.
Another thing too that's worth talking about, perhaps a little bit, is that protectionist sentiment and how that might impact Canada, especially because it does appear that Trump's holding it over the NAFTA negotiations, which, from what I'm reading, don't seem to be going swimmingly well. So obviously all sorts of uncertainty out there, and I think that uncertainty is going to sit very heavily on the Bank of Canada's shoulders as they make decisions about what they're going to do with interest rates. So I agree that they're probably less likely to raise interest rates in any major way as the Fed does go ahead and raise interest rates.
Yeah, and I think one positive is the bank's well aware of this. They've mentioned it several times over the last 6 or 12 months. They're well aware of the NAFTA situation and the consumer leverage in our economy, et cetera. So they're aware.
Yeah. And of course, with raising interest rates, we make mention of how that impacts the consumer to a degree. And as I mentioned a little bit earlier, debt levels in the U.S. have risen now back above where they were at the peak in 2008. A lot of it has to do with credit card and auto loan debt, and a lot of it is where the millennials have been borrowing to a large degree. The other key part of debt is, are people paying their making their payments? And this will show you that there's delinquencies are rising in both those credit cards and auto loan situations. So with interest rates going up possibly another full percent, this is going to have some impact on the consumer, don't you think?
For sure. Yeah, absolutely. And Canada would look even worse if we had that data.
Yeah, yes. But again, interest rates probably not going up as fast in Canada given the situation, but we still are watching carefully. And I don't know if you've have any updates on the housing market in Canada, but certainly in Toronto, uh, prices have been falling and sales have been falling, I think, right?
Yeah, you know what? I'm too busy. I haven't checked in on them for the month of February. I'm sure the data is out. I should probably do that and update my spreadsheet and maybe
Yeah,
write a
we
quick
could we
blog.
could talk about that next week
Yeah.
or in 2 weeks. You're off next week? I think we're
Yes, and right.
perhaps.
Oh
So
no, I'm here. I'm here Monday. Perhaps we can do it.
okay, then that's just the segue into saying have a good week to everybody. But we will be back. We'll do it on Monday next week, and look forward to talking about some other things and perhaps the housing market in Toronto. But until then, this is Scott, and on behalf of Paul, I will say and wish you all a great week.